Do you want to learn more on how to put money to work in regenerative food and agriculture? Follow our video course via investinginregenerativeagriculture.com/course or in the links below. Now, on to the podcast. You will listen to a check-in interview with Tony Lovell where we discuss how his $100 million Regen Ag Fund is doing after 6 of the driest years ever recorded. Welcome to another episode of Investing in Regenerative Agriculture, Investing as if the planet mattered, a podcast show where I talk to the pioneers in the regenerative food and agriculture space to learn more on how to put our money to work to regenerate soil, people, local communities and ecosystems while making an appropriate and fair return. Why my focus on soil and regeneration? Because so many of the pressing issues we face today have their roots in how we treat our land, grow our food and what we eat. And it's time that we as investors, big and small, and consumers start paying much more attention to the dirt/soil underneath our feet. Before we get started, I've been recording these interviews next to my day job, and I will definitely continue to do so and release about an episode a month. But at the same time, I would love to take this further, share more interviews. There are many more stories to share on investing in regenerative food and agriculture. More depth, improve the quality, maybe even doing some video series. So I started a Patreon community, which makes it easy to support creators like myself. If these podcasts have been of value to you, and if you have the means, I invite you to support me and make this happen. For more information, please find the link to my Patreon account in the description below. And now, without further ado, the interview. Enjoy! Welcome to the podcast. Today I'm speaking to Tony Lovell, co-founder of SLM Partners. I interviewed Tony before in October 2016 as the second interview ever on this podcast. And I'm very happy to check in with him again and see how things have developed in the last almost 3 years. Welcome again, Tony.
Thank you very much. Pleasure to be here.
So to start with a question, I will definitely link the interview we've done before in the show notes below. But for those who haven't heard it, what is SLM? What has been the strategy of the fund in Australia? So let's get into a few of those details.
Okay. SLM Partners SLM stands for Sustainable Land Management. So we started in 2012, raised $75 million from a Danish pension fund, another $30 million worth of finance from an international bank, Rabobank, who are an incredibly supportive agricultural bank. Both of those groups are very supportive of the agriculture. What we did was we acquired large areas of what we described as inherently good quality country that had been degraded by inappropriate management, unintentional but inappropriate management. And as a result of 150 years of set stocking in a seasonally dry, erratic rainfall and ecosystem, productivity, production, performance, biodiversity, everything had gone south, had reduced. So the intention was to acquire that property, spend money on infrastructure, water, fencing, upgrades, and then change the grazing management with the intention to, over the life of the fund, a 10 to 15-year fund, double carrying capacity, halve cost of production, and be a large-scale, low-cost producer of high-quality grass-fed protein. That was the project thesis, and it remains the project thesis. We also said that we would, as the opportunities arose, monetize, I don't like the term, but ecosystem services, so carbon offsets, water and air quality offsets, whatever came available, biodiversity credits, and we've been able to do that as well. So that's the basic thesis of the fund, a very simple process: buy the land, do the infrastructure, change the management, and allow nature to recover and bring back the productivity that the land inherently is capable of.
And in terms, just to give people a sense of scale, this is in Australia, so everything's big. How much land did you buy and what? Because we can imagine, okay, it's about just north of $100 million you raised.
Yep.
How much land does that get you? What are the dimensions which you think of?
Okay, well, the total amount of land that we have in the fund itself is 480,000 hectares, actively developed with water and fencing and the infrastructure, etc., is about half of that, 240,000 hectares, and the other 200,000 hectares is large scale in Australia. Mulga is a leguminous native tree, and it's a carbon project, so a regenerative carbon project with less intense management, but the intense management is on the remaining part of the country. So it's a fair chunk of land, yes.
And When did you start? I mean, you said 2012. When did you raise and did you start buying your first properties? Was it the same year? Was it slightly after?
We had our first close in June 2012. And we started acquiring properties shortly thereafter. Took possession of our first property at about December 2012, January 2013, had finished our acquisition stage by the end of 2014, and then just stepped into long-term management and waiting for it to rain, basically.
Yeah, because let's discuss that a bit. We've discussed some drought before in 2016 when we did our first interview, and you even discussed the decision you made within the holistic management decision-making framework to actually destock. Where are you now as we're talking in July 2019? And I think it did rain a bit finally.
Yeah, okay. So a couple of things on that. The land that we've got is, in terms of holistic management talk, is brittle tending. So it's erratic and unreliable rainfall patterns. Long-term average rainfall for the country we've got is around that 375 millimetres a year, but that can vary widely. We bought in 2012 off the back of two very good seasons. Our country also gets beneficial flooding, so we'd had two very good seasons. Unfortunately, with conventional management, the benefit that we should have received from that was pretty much ephemeral and didn't really run through. So we then ran into 6 of the driest years on record. Effectively, if the average rainfall is 375 mils, we were down to like 100 mils, 200 mils. So we were less than half of long-term average rainfall year on year, 6 years in a row. What that means is the first year is tough. The second year compounds off that. Keep going forward 5 or 6 and it gets pretty challenging, to put it mildly. One of the things that we do, I think is critically important, is we match our stocking rate to our carrying capacity. And I describe us as being fully stocked, as in properly stocked. We had the correct number of stock for what the land itself could carry. We assessed the land could carry no livestock, and we matched to that. I believe nothing is more economically damaging than running animals on land when the land can't sustain that. It's also incredibly ecologically damaging and socially damaging, but it's fundamentally economically damaging. We have probably in the last 3 to 6 months actually had some reasonable rain. We had between 90 and 130 mils. We are still a long way short of where we would like to be on a long-term average basis, but that was combined with some beneficial flooding. As we speak, on the land that we've got that received the beneficial flooding, we are back up to just shy of 5,000 cattle, and we should be able to run those through for the next 6 to 9 months. And we're hoping to get some follow-up rain to continue the project moving forward.
Yeah, because I can imagine it has been extremely challenging, especially as you are in a project that has a sort of deadline after, I mean, you mentioned 10 to 15 years. It's not that you could run it maybe longer, but theoretically, at least the fund has an ending date. It's not an evergreen. How has that been the process with your investors and with all the people involved, that you got those 6 horrible, very dry years right at the beginning, basically, of the fund? Has it been a tough process to basically get around?
It's been character building. I have far more character than I ever thought I'd needed. So it's been very challenging during that period of time. The good thing from 2 points of view, the investors understood at the start. So the basic pitch was we would buy land that was inherently good quality land that's been degraded by inappropriate management. And over the life of the fund, we would double carrying capacity and reduce cost of production. The question that was always asked was, how long would that take? The typical how long is a piece of string type question. And my answer to them was always consistent to everyone we sat in front of when we were looking at raising capital. It was very much, it depends. It depends on seasonal conditions. If we get a run of good seasons, it could take us 3 years. If we get a run of average seasons, it could take 5 or 6 years. If it's really tough, it could take 7 or 8. Now, we ran into the longest, toughest, driest period on record, on white settlement records here in Australia for that particular block of country. The investors, not necessarily ecstatic about that, but they appreciated and they understood that, and they are a long-term investor. Our financier, Rabobank, our manager there, basically said to me, they don't panic too quickly. And I think that was because they're a purely agriculture bank. They understand that process. So On the ground, the interesting thing has been the staff, our team have been very positive the whole way through because they can see the benefits of the decisions we're making and they can see that playing out on the land. And especially after we did get the rain event and the flooding that came through, it is noticeable the difference in response of our country managed appropriately or managed the way that we consider to be the correct way to manage it compared to conventionally managed country over the fence on our neighbours' properties.
Yeah, I think that's a very interesting point, both from the investor and financier perspective, as I think the Danish pension fund, but correct me if I'm wrong, has other positions in cattle. And obviously Rabobank is one of the biggest lenders in the world, probably the biggest in agriculture. And the drought was there for everyone. So what has been the difference on your land or the land you're managing versus the neighbor's land? And has that been interesting to your investors, but also to your staff? I mean, you mentioned your staff, but also to your investors to see the differences that your decisions and your management has made.
I think from the investor's point of view, they're basically in a holding pattern. They're not overly concerned about it. They're not actively involved in it because, let's be honest, there's not much they can do about it. Where they had a review of the process, they had a look at what we were doing and they said, okay, well, everything that we've said would happen is happening. It's just a case of waiting for seasonal conditions to swing back. And long-term averages, reversion to the mean is something, I mean, unless there's been an incredible collapse in climate, this country will revert and come back to some above average seasons to balance up the below average seasons. That's just what happens, and we have to be patient and wait for that to occur. The interesting thing is on the land itself, the way I describe it is we're going broke slower than anybody else. We weren't making money because we had no stock, obviously, but because we weren't feeding and we weren't degrading our ecosystem, we were holding our own, and we were actually in a position that when the rain did come, the very interesting observation from several of our managers, and you could see it on the land, was that our land had far less runoff. So this is land that has been parched and desperately looking for rain for 5 or 6 years. And when the rain event did turn up, the amount of land that rejected that rain was terrifyingly disheartening. It was just shocking that, nice, steady, gentle rain, but it ran off because the land had been so degraded that it was unable to accept that rain when it did arrive. We had very little runoff in our country, which means that what we did was we got the benefit of the moisture when it did turn up. That will take time to build on that again and again, but you start to build an ecosystem that actually accepts the moisture when it's available, whereas in a lot of cases, a lot of these seasonally dry ecosystems have been so degraded that they actually reject the thing that they most desperately need when nature does provide it, which is fairly perverse but unfortunate reality.
And do you see that in, these 6 years of drought in the neighbors or in the same area, has it been basically a lot of people closing up or selling or really or going broke, like you mentioned before? Has it grown the interest in regenerative agriculture? I think that's my bigger question. Do people see the difference now with the land you're managing? I mean, we've discussed this in the first episode, that it's very, very difficult to go against centuries of agriculture and to be called stupid land management. I think you were mentioned more than a few times in the communities you entered. Has these extreme conditions, have they created maybe more space for the Regen Ag space?
I think there's definitely more space in there. I think the opportunities, the number, we've got neighbours who join us on a couple of different places, and they fly, light aircraft because of the distances out here. And the number of times they've said to us that they know when they're coming over SLM country because from the air it's not shiny.
Meaning it's green, yeah.
Well, not necessarily green, but it's not shiny. So if it's a bare ecosystem and it's been polished flat by animals and inappropriate management, then the sun's reflecting off it much more strongly. So we have, if I look at some of the neighbouring properties and some of the, for large areas of that land out there, not just the neighbours, but that whole ecosystem, and if you were using a single term to describe it, my term is hard or harsh. It's sharp. It's got definite edges to things, and the plants themselves look hard and harsh and sharp. Everything's got a roughness to it. If I look at our country, you can see some softness to the edges. You can see that we do have some herbage and some soft cover, and the trees have actually got some leaves and some foliage on them. The edges are a little bit rounded and a little bit more soft and gentle is what I see on our country. Now, in terms of the acceptance in the neighbours, we've had one of the neighbouring neighbouring families, and they're a very good long-term family in the district, been very successful conventionally. They've just recently done some of the grazing management and the changing, and that came as a pretty big shock to one of the older of the three brothers. Their biggest challenge is what they actually do with it now in terms of how they change their management, how they work that, especially having come through 6 fairly tough years financially. For them to make the changes they need to make, how do they actually fund that? And that's the questions that start to come through. But there is an awareness and an opening up of that, definitely.
Yeah, because it seems like many of the pioneers, at least in Australia or also in other places, started from a place of basically being nearly broke and being forced to change. I don't see many that had a huge amount of money in their bank account, had the luxury of thinking about it, but many actually are forced to change either because of drought or because of other decisions. And then that change is needed and is almost forced upon them. And luckily some make the decision or at least go into the regen ag route and slowly get out of it. Obviously, it's not easy. It's very complex. And transition finance, as maybe this family needs, is something that is absolutely necessary once you've made the decision to speed it up, basically.
Yeah, I think there's a couple of things in there. I think that it's like human beings. You know, that as an older man, a lot of times the reason that you actually get fit is one of your friends dies of a heart attack in their 50s, and you go, God, mortality is hitting me in the face, and it's a shock to my system, and I need to change something. From the agricultural point of view, yes, it usually is a desperation, because if things are working for you and you have a big pot of money in the bank account, why change? Why risk changing something that's working well for you? You need to have some degree of discomfort before you actually make that change. I think that's important. Or there needs to be something change in your mindset or your ecosystem for you to want to make that move. So on the transitional finance part of it, I think the important thing and the interesting thing is that let's compare a couple, and that's why I gave the example, and my description, my somewhat flippant description, was that we're going broke slower than everybody else, which is important in times like this because it means you can survive and sustain and come out the other end. You need to have some sort of a buffer underneath you. I think what's interesting is some of the neighbours who were feeding their sheep and feeding their stock, and they're out every day buying in feed, buying in hay, buying in cottonseed, buying in whatever to keep their animals going. And at the end of the thing, they say, well, their wool clip covered their feed cost. And you go, that's nice, but it didn't cover all the fuel, and it didn't cover all the wear and tear, and it didn't cover all the emotional stress and strain on them doing that. And critically importantly, it didn't cover the damage to the land and the decrease in your asset base. The problem is that in conventional financial reporting, that asset base, the land itself, the inherent productive quality of the land, whether that's organic matter or soil carbon or whatever factor we want to sort of base it on, that's not taken into account. And so people say out in that country say, it always bounces back, it always bounces back. And it's a bit like dropping a tennis ball. It bounces back, but never quite as high as it bounced the first time. And it slowly keeps bouncing lower and lower. And people lose sight of what it did look like. And there's no direct economic connection between where the land could be and where it is. They don't see that vast gap in productive capacity. Second thing I think is critically important in making the transition, especially when things are dry, too many people wrap themselves up in their value as a human being, as a farmer, as a rancher, is having animals. And if there are no animals on the property, what are they doing? And if they've completely destocked and taken all the animals off, at some level, it's an admission of failure. Whereas my perspective is it should be an admission of success because you've done the right thing. But a lot of these people consider that if they haven't got any livestock in there and they're not doing it tough and they're not covered in dust and sweat and dirty clothes and out there struggling and doing what they think is the right thing, then their personal value has been degraded because they're not doing the hard stuff and they're not toughing it out. And we often had that. We had some of our managers were asked, so what are you guys doing? What are you guys doing? And, I sort of said to them, well, it depends how you want to go. You can just say, well, we're just doing so. Or you can say, what we're doing is we're doing all the work that nobody did before because they were doing the wrong stuff. So we're catching up. We're maintaining the property. We're getting everything ready for when the seasons come our way, which is what we've done, and we're getting the benefit of that now.
Meaning putting in water infrastructure, fencing, and all of that.
We'd already done the water and fencing infrastructure. In a lot of these cases, I sort of describe it that In some of these areas, people ran out of ecological, emotional and social capital, financial capital 2 or 3 generations ago, and they've been going through the motions. And, there are a significant number of people who are probably trapped on the land because they inherited it and it's their 3rd or 4th generation and they have to do the right thing to keep the whole family thing going. So what our guys were doing was basically tidying up, just pushing rubbish into piles and holes and cleaning up, straining up all the old fences. We put a lot of internal single wire electric fences, but obviously you've got the previous existing fences that were on the property. A lot of those needed work. So they're straining up all those fences and just going back and tightening things up and just general keep things shape and Bristol fashion, bringing the quality of the property up. That's been the big part of it. So it's all been productive work, maintenance of vehicles, tidying up sheds, just little things like spending a half a day and screwing the roof down, taking the old nails out and putting screws in so that if a big storm does come through, you don't lose the roof off the shed. A massive number of things that are probably, jobs that have been accumulating for 30 or 40 years that you didn't get a chance to do, and you wouldn't get a chance to do in a good season because you're out moving the animals around and doing all the work that comes with that. And in a bad season, when you should be adjusting your numbers down, taking advantage of that to do that big catch-up work, you're out there feeding the animals and keep, so you never get out of that locked-in loop of being busy for the sake of being busy.
Yeah, no, it's extremely interesting. I mean, taking the good years and the bad years, and not bad, but adjusting to that and using the time to do, 30, 40 years of small tasks that end up being quite a lot.
And if you're on a 120,000 acre property, 40 or 50,000 hectare property, those little tasks, if you have a small task per hectare, you've got 50,000 tasks.
It's a few months' work. Yeah.
It adds up very rapidly.
And if we look, we talked in October 2016, and now we're in July of 2019. What have you seen changing in the regen ag sector? We can get into the investor part a bit later. I think it's very interesting because I think for both of your financiers and investors, it was the first time they got into regen ag, or one of the first at least. Mm-hmm. But in general, what have you seen changing in the sector as somebody that's deep on the inside and has actually run one of the biggest funds in the space?
I think there is an increasing awareness of the need to make some changes in how we're doing agriculture. How directly that transfers or translates into action from an investor point of view is a little bit questionable. There's a couple of things that have happened. So in Australia, they're talking about, obviously, we have the Australian Carbon Trading Scheme. So SLM has 4 projects with the federal government selling carbon offsets. So we are, as a result of our change in management, we're regenerating and regrowing mulga and producing more biomass and getting offsets for that. So that's been a very positive part of the process in terms of monetizing that.
Which is above soil carbon, right? It's not soil carbon, but it's coming, right? It's coming as well.
Yeah, exactly. It's basically tree cover. It's increasing tree cover.
Okay.
Soil carbon is still a fair distance away practically in Australia. There's been some credits sold, but in terms of getting it to scale, we've still got a gap between where we are and where we need to be on that. The federal government is talking about a biodiversity project in terms of getting funding for biodiversity. And Queensland, one of the states in Australia, has a biodiversity fund that they're sort of doing some projects with. So there's some government funding and some awareness around the biodiversity and how they actually, early stages in terms of what do they measure, what do they record, what do they pay and reward based on is still to be determined, but at least there is that move starting. Investor Group on Climate Change and some of the other larger institutional groups, I think the gap you've got is between a project size that makes sense from a third-party manager like an SLM to run, where you have to have a certain amount of capital involved to be able to generate enough fees to be able to pay for the people that need to be there to run the project. So there's a certain minimum size, and how you balance that minimum size up with a project that makes sense with the requirement for the larger institutions to be able to deploy their capital in big chunks. So some of these multi-billion-dollar institutions, pension funds and high net sovereign wealth funds, etc., want to be able to write a single ticket of $100 million or $500 million, but they don't want to be the only investors, which means they're looking for investable product that's $250 to $500 to $1 billion, which is pretty hard to make sense of in the regenerative space. So that's the gap, is between the project size that the current group of managers of regenerative agriculture can realistically run and, hand on their heart, tell an investor they can package and put together and show some track record on, and the sheer size that the big investors want in a project. And there's some gaps in that part of it.
So basically from the 100 million to the 250 to 500 million, which seems not a lot, but it's a 2.5/5 times, which makes everything very, 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 very different, very complex. And you need a lot of different things, a lot of different managers, a lot of land to be able to buy if you're going for the buy and hold strategy.
Yeah, and you've got, if you think about it, it's not a direct relationship, a direct scaling relationship, but you need to be able to have 2 to 2.5 times as many people on the ground who have the training and experience in regenerative ag. And that there's the number of people who are out there doing that. Coming back to the start of the conversation, where the people who've made the change to regenerative ag are usually family farmers who have had some stress or some strain in the system and have made that move. Having made that move, they've solved their problem or they've alleviated their concern. They're not then saying to themselves, I'd rather leave the family farm that I've spent all this time and effort getting back on track, and I can see all the benefits, and my family's happy, and we're making money, and the land is happy, and my life is good. That's our resource base in terms of the intellectual capacity and the experience of running these properties. But you can't pick them out of that and say, let's go and run something else for an institution, because they don't want to do that.
Why would they? Yeah,
that's right.
Created their own piece of paradise, and why would they leave? Yeah.
Exactly. So then what you've got to find is, who do I get to fill that gap in, and how many of those people are out there of the right experience, capacity, quality, attitude, etc. I can find enough to run $250 million worth of whatever the investment is. Can I find enough to run 500 million? Well, that's twice as many people. And I've just got, you start to run out of people, unfortunately, on the way through as well, I think.
Is that the biggest constraint in the sector at the moment?
I don't think it's the biggest constraint. I think it's the gap that you've got is somebody coming into investing in regenerative ag. There is a transition period. So you're either where we are in large-scale, extensive country that hasn't had a lot of artificial fertilizer and artificial inputs, but has been degraded. You're waiting for seasonal conditions to allow nature to recover. And that little hockey stick curve, that little change, is going to take some period of time, 3 to 7 to 10 years, whatever that period is. You start to move into, say, a transition from conventional cropping, high fertilizer, high tillage, etc., to a more natural, less intrusive cropping program. You're taking land off artificial support, and that land is going to take a while to change and heal itself up, because the biology that's needed for the crop to grow without those artificial fertilizers has been suppressed because of the artificial fertilizers. There's going to be a gap in that period of time. So for an investor to come into the program, what they've got to do is really have a reporting time frame. They've got to have an overall picture that's at least a 15-year investment horizon. So when they start, they're in for 15 years, and they probably need to look at it in year 5 and year 10 and not worry about in the middle. If they look at it too often, they're going to see the drops and not understand what's happening. And they've got to say, okay, we're in here for 15 years minimum. And during that time, we will look at it seriously in year 5 and seriously in year 10. That's from the reporting side of it. From the balance sheet side of it, what needs to come onto the program in terms of the balance sheet is appreciating and actually recording that the real asset you've got is the ecological health of and resilience of your land. And how do you actually track that? And that's the biggest thing that's probably been missing from an SLM's point of view, is during that 6 years, we have made changes on the land, but that's not reflected somewhere because it's waiting to come out of the productive increase once the seasonal conditions change. But if you had some reporting process that had biodiversity measurements, whatever they are, soil quality, health, soil carbon measurements, some aspect that gave you a real feel for what the asset base itself was doing. so that even during that time while that transition is happening, you can see my asset is improving, and I'm going to get the benefit of that in year 5, year 6, year 8. That's probably the two things that I'd see is the investment horizon and the frequency of checking in, especially with the regenerative process. And the second thing would be bringing somehow into your accounting system and your record-keeping system the real asset, which is the ecological health of your land.
And is that the biggest thing you would do differently if you would do it all over again? What would you do differently looking at the fund, looking at SLM? With the knowledge, obviously, you have now, you wouldn't know 6 years of drought. I mean, that's unpredictable. But what would be your change?
Yeah, it's basically sliding doors. I mean, if we had had the seasonal conditions on the way through a couple of different seasonal events, everything would have changed. And you look back, and the biggest problem you've got is that you look back and you compare what actually happened with an imaginary alternative scenario in which no problem occurred. Okay, and obviously there is some problem that would have occurred.
Yeah, it could be something else. Yeah.
We probably raised less capital than we needed for the strategy itself. The original strategy was a $300 million fund. A $300 million fund would have been in 3 or 4 different geographic locations in Australia. And while things were tough in one, we would have balanced that off a little bit. So a bit of the diversification aspect of that. From the infrastructure point of view, maybe a couple of slight changes there. It's really hard because you're looking back on 6 incredibly tough years.
It sounds like you wouldn't have done so much different, actually, except for raising more money. But of course, you tried to do that. Yeah. It wasn't that you said no to 200 million somewhere along the way. Yeah,
exactly. I mean, this is the thing: is that probably 90 to 95% of what we did, I'd do again. There's a few things we would have changed. If I had have known we were coming into 6 incredibly tough years, then I would have said, stayed at home and done something different. But having said that, we would not have achieved what we've achieved on the ground. So if I look at it, we're providing millions of carbon offsets per annum into the Australian government fund. We have regenerated the ecosystem. We have made major changes on the land. We are seeing the benefits of that coming through now. What we've done, drought itself doesn't degrade a grassland. Management during and after the drought is what degrades the grassland. And what we've done is we've managed appropriately during that time, and we're starting to see the benefits of that. So, my fundamental belief is that over the investment period of the fund, that 10 to 15 years, we would double carrying capacity, halve cost of production. I'm 100% convinced that over that time frame, we will achieve exactly that.
And obviously with the carrying capacity based on the actual carrying capacity of the land, not just some imaginary number. And you've proved that you are able to adjust to that as you basically destock because the carrying capacity in the dry years was very, very low, maybe even zero.
Yep.
So carrying capacity is not just a number that comes out of a spreadsheet. It's a number that's based on the land.
Carrying capacity is what comes up from the land. So what the land itself can do. The stocking rate is what we put down on the land. So we match the number of animals with what the land can carry. And if you get that right, then that's number one factor. Get that right and things start to work really well. And the way that will work, what will show is basically the number of animals that we did graze, the number of animals that we did sell, the number of animals that went into the marketplace. And that's pretty much, in black and white, and with Australia's National Livestock Identification Scheme, where every animal has a radio frequency tag in its ear, they're either there or they're not. It's pretty straightforward.
And so what is happening for the next part of the year until the end? Are you hoping for rain? Are there any other big events is there rain coming, as you know? How does the year look like, the rest of 2019 for you?
The rain that we got, the 90 to 130 mils of rain that we got, was out of a forecast that said that we expected to get somewhere between 5 and 10 mils. So it surprised us on the upside. The number of times that the rain that's actually turned up as surprised on the downside outweighs that. The seasonal conditions are showing being sort of average long-term for the next 6 to 12 months. No dramatic changes. Having said that, the country that we're in, looking at 150 years worth of records, each month can be a record-breaking month and it can come out of nowhere. Normally, a very large long-term drought is broken by a very out-of-nowhere type rain event. A big cyclone will form, an out-of-season cyclone, some big tropical rain event will start to come through. That's incredibly unpredictable. So what we do is we deal with the reality that's on the ground. And at the moment, we have had some flooding through our land. So On 140,000 hectares, we probably had 30 to 40,000 hectares receive beneficial flooding. We've done our assessments of our carrying capacity on those, and we've got animals in that match that, with the intention that those animals have a solid 6 months worth of feed in front of them. They're young breeding females, which means that during that period of time, if the seasons don't improve dramatically, we have taken them from a smaller weight to a larger weight, and they become an animal that can be sold into the feedlot market or whatever. If we do get a good seasonal change, they're an animal that then can get joined and become a reproductive animal producing calves down the track. So we've got a couple of options there.
And I want to end with the question that John Kemp often asks, and I borrowed it from him, adjusted it slightly. Mm-hmm. What do you believe that is true about Regen Ag that others don't believe to be true?
That it works.
I think it's a perfect answer. Thank you, Tony, so much for your time.
Thank you.
It's always a pleasure, and I will definitely check in earlier this time, not after almost 3 years.
That's fine.
And let's all hope you get some beneficial rain. Not too much, not too little, just the right amount.
We'll take more than less, trust me. We can cope with as much as nature will provide.
Thank you so much, Tony. Have a great day.
Been a pleasure. Take care. Thank you.
If you found the Investing in Regenerative Agriculture and Food podcast valuable, there are a few simple ways you can use to support it. Number 1, rate and review the podcast on your podcast app. That's the best way for other listeners to find the podcast, and it only takes a few seconds. Number 2, share this podcast on social media or email it to your friends and colleagues. Number 3, if this podcast has been of value to you, and if you have the means, please join my Patreon community to help grow this platform and allow me to take it further. You can find all the details on patreon.com/regenerativeagriculture or in the description below. Thank you so much, and see you at the next podcast. Dear friends of the podcast, I'm super excited to share with you the online video course Investing in Regenerative Agriculture and Food. How to put money to work in regenerating soils at scale and growing a lot of tasty food while doing it. Why are we doing this course? After 100 interviews and more than 100 hours of audio asking the question how to put money to work in regenerating soils, and have been following the space since 2011 and recording these podcasts since 2016, we thought it was time to share our lessons learned. What have we seen in the space over the last years? How have we built our decision-making framework? What to focus on with the podcast? How have we picked interviewees? What questions should you ask? What is happening in the space? What should you read? What should you listen? What should you watch? How to approach this space? For whom is this course? You, the soil builders and investors in this space. The soil builders, people working in this space, entrepreneurial farmers, fund managers, vehicle builders, crowd investing, platform builders, ag tech companies, farm-to-gut food companies, permaculture, keyline designers, holistic management consultants, etc., etc. People that are building soil at scale. And the investors who are putting their own money to work through their family office or as private individuals, or people who are putting other people's money to work through foundations, institutional capital, banks, insurance companies, etc. Is this course free? No. This is pay what you think it's worth. Meaning, I have no way of knowing what this course will be worth to you. And I'm very aware that among the listeners of this podcast, we have people with very different means. So I'm inviting you, if this course is creating value to you, and if you have the means, to consider paying what you think it's worth. Thank you. So what is this course? It's currently a series of 17 videos, mostly ranging from 10 to 15 minutes, plus PDF slides, so you don't have to ride along. We're going to look into why invest in regenerative agriculture and why extractive agriculture is so risky, how to invest, what kind of frameworks you could and I think should build, what to invest in, what kind of co-investors you could find, or what kind of investors you could find if you're a soil builder. Every lesson will have a digging deeper part where I will share what kind of reports, what kind of interviews, what kind of videos you can look into if you want to dig deeper. We're going to look at nutrient density, landscape design, and a lot more. So what is it not? It's not a list of investable deals. Unfortunately, that doesn't exist in this world. We're really at the beginning of the regenerative agriculture and food revolution. It's also not investment advice. Before making any investment, please find professional investment advice. So get ready, get a cup of coffee, a cup of tea, or whatever you're drinking. Click on the link below, sign up, and I'm really looking forward to your feedback.